Thank you everyone for joining us today. I'm very excited to moderate this session as it's very near and dear to my heart. My name is Amy Adams. I'm a senior manager in the tax group here at SBSB, and I'm joined by Dave Merrill, our tax director here at SBSB. And also joining us is Ian Halligan. He's a director at Baker Tilly, and if you're unfamiliar, Baker Tilly is an international CPA firm, and Ian is joining us from the Oh, it just happened. So I don't know if we missed my intro. Well, the way we're going to do this today is I have several questions that I'm going to pose to Dave and Ian. Again, let me introduce them in case that wasn't live. Thanks for joining us today. I'm very excited to moderate this session. It's near and dear to my heart. My name is Amy Adams. I'm a senior manager in the tax group here at SBSB. And joining us is Dave Merrill, our tax director at SBSB. And also joining us is Ian Halligan. He's a director at Baker Tilly. If you're unfamiliar with that firm, Baker Tilly is an international CPA firm, and he's joining us from the balmy Chicago office. The way we're gonna proceed today is I'm going to pose several questions to Ian and Dave, and they're going to get out their crystal balls and give us their thoughts on what they think about our tax policies and our new administration. We saw a lot of new tax changes in our last administration, so I know it's top of mind for everybody. And let me see if I can just get this screen sharing to go away. And I think we'll just get started. I think the big question on everyone's mind, let's just get right to it. Our tax policy is going to change this year. So what is your take? Let's start with Dave.
Thanks, Amy. As Amy said, we're really excited to talk about some of these things today. We're going to be talking about what we're seeing, what we're hearing, what we're reading. But as many of you may know from tax policy changes in the past, we don't know what's happening. It's a little bit of a guesswork at this point as it's getting worked out in the halls of Congress. And so we're going to give our thoughts and give our guesses, but we don't know. We're going to play a little bit of meteorologist. Your first question, I think, Amy, is easy to answer very shortly, that we are going to see tax law changes, and there's a few reasons why I say that. One is because they're working on one right now that we're hearing about every day. This new package labeled at $1.9 trillion that Biden's pushing through and the Democrats are pushing through, and frankly, Republicans want to push through as well to get more pandemic relief to Americans. So that's one reason why we're going to see change. Another reason I think we're going to see change this year is because it's been promised in all the campaigning that happened that there would be changes in tax laws. And then also, if you look at the last few years, there has just been so much change in tax policy. The Republicans in the 2017, when they passed the Tax Cuts and Jobs Act, they wanted to start a new way of thinking about tax law, and they wanted to have more frequent changes that were smaller in scope. Well, we've seen more frequent, but all the changes we've seen have been pretty dramatic, and I probably expect that to continue. Ian, do you have any thoughts?
It's a curious one, right? A lot of things promised on the campaign. Biden sort of outlined a lot of policies, which I'm sure we're going to get into later. But from my perspective of how many and when, I mean, there's kind of a long list right now of things that I think they want to enact. But I'd be curious to see, whether we try to go for all of those this year, whether they'll be effective if one of 22, or some of them will be effective immediately, and whether they try and go the other approach, which is get a few of the sort of high level ones, the sort of favorite ones through now and work on the others later. So it's going to be an interesting 12 months, that's for sure. And the pandemic's probably not going to help in terms of getting some of these things through Congress while everybody's working on everything else. But yeah, as you said, it's a bit of a crystal ball gazing here. But my guess is, something, not the whole list gets done this year. They try and get a few through, effective the beginning of next year, and we'll kind of go from there.
That's actually a really good point, Ian. What priorities do you think President Biden's going to focus on in his tax agenda?
Well, I think there's a few that seem to be sort of key priorities. I think one is, the estate tax. I think the idea is to try and get the exemption down to 3.5 million. I think there's a push to get the step-up basis on death removed and the tax rate back to 45%. Now, the interesting part about the exemption is that sunsets, I think, in 2025 anyway. So whether they try to just go for a tax rate approach or the step-up basis approach and ignore the exemption because it will sunset, I don't know. The other one seems to be key is sort of eliminating that long-term capital gain and qualified dividend rate for people who make more than $1 million. That's another interesting one because it depends on what effective date you pull in and whether that has any impact on people's behavior going forward. If you know, you enact something this year that's effective 1/1 of 22. And I think the sort of third one in terms of high net worth individuals is, you know, individuals making more than $400,000, they'll lose the qualified business income deduction, and the Social Security tax comes back into play there. So those are sort of the three key ones I see right now. But you know, again, who knows whether it's all of those, whether it's all of those and more, or whether they just key off a few. I know, you know, some of the rhetoric on the campaign trail early on in terms of a wealth tax sort of led me to believe that was, you know, that or the estate tax was a priority. But I guess time will tell. Dave?
Yeah, Dave, do you have thoughts on that? Because I think we can all agree taxes are going to go up. Do we have any thoughts on when we can expect this? Maybe trickling of some tax policies over years? What do you think we might see?
Well, you got a lot of questions in there in one. Let me respond first to what Ian said. All of those things that he mentioned, the wealth tax, capital gains rates, and all the impacts on people. 400,000 is the number that we heard a lot of times on the campaign trail from Biden of where he wanted to draw the line on whether it was Social Security taxes or some of the tax, just regular deductions. Wealth tax is something that was talked about, and I really believe wealth tax is going to change in the next few years. I don't see that as a high priority for Biden. I think that'll be an interesting one because there will be some Democrats that are pushing really hard for wealth tax changes. Elizabeth Warren, for example, heading the committee in the Senate, will be pushing for that and has very vocally for a long time. And there are a lot of different ways the wealth tax could change. I don't anticipate big changes on that soon, except for maybe the sunset that's already been scheduled that we already knew about. So I think that'll be one change. I think that the capital gain rates is a big one, and we'll have to wait and see what happens. As you mentioned, Amy, people expect tax rates to go up rather than down. And so we've been getting a lot of questions of, well, when's that going to happen, and what exactly is going to change? Well, I think the reason why we have this idea of rates going up is because the Democrats have a big agenda. They're talking about infrastructure. They're talking about environment, climate change, green energy. They want to shore up insurance. They want to shore up the elderly and the programs that are in place for there. They want to help housing problems. They want to help poverty. All these things are on their agenda, and all of them cost and put pressure on the budget. And so there's going to need to be ways to raise that revenue. You asked when. That's a great question. Right now, Biden says his focus is on the pandemic and pushing things forward there. And right now, the laws that they're working on changing all have costs. They're looking at sending out direct payments again to American families. They're looking at increasing the child tax credit, increasing the earned income credit, all these refundable tax credits. And those are going to cost money, but there aren't really revenue raisers that they're talking about yet. The next bill they pick up, I think they want to focus on infrastructure, but I think they're going to be looking at some of these priorities Ian is mentioning, and it could be as soon as this summer that we start to hear about what that looks like and what pieces they want to incorporate. Ian, what do you think on timing? You mentioned this year, next year. What do you think?
Yeah, it's an interesting question. You know, I think the effective date is kind of curious to me. You know, we've seen backdated tax changes in the past, but it's normally been for tax cuts, not tax increases. So I'm curious to see, you know, how they approach that. You know, again, my gut feeling is they'll try and push something through here towards the end of the year. I don't think it's going to be the entire list, but they'll address a couple of these key ones we just talked about. and try and get something enacted for 1/1 of 22. But yeah, when, at this point, again, nothing would surprise me. It's been a strange year with the pandemic. So, I'm just still too, who knows what's going to come down the pipe. But yeah, that would be my guess, is that something gets enacted here before the end of the year, but it's not, the entirety of the things that they're looking at.
Yeah, you're right on it. Just being hold on to the seat of your pants as things have just changed. Things we wouldn't have expected have really pushed through. But there are some tax law changes that have been talked about for years and years and years, and are finally making their way into some of this legislation. So it's I think that's a good process to see it vetted over a number of years. But all this stuff was just thrown in and is new for practitioners. We don't know that it's coming, and then it makes everything a little more difficult. As far as timing goes, I would think that January 2022 would be my guess for when some of the biggest changes happen. Take capital gain rates, for example. If a change is made that those earning more than $1 million have their long-term capital gain rates match their ordinary income rates, I would think that happens it would be effective 2022 would be my guess, but it's hard to say.
Great. Well, it seems to me that we might have some issues with the slim majority in Congress. How do you think that's going to affect tax policy? Is it going to change the things that go through and the timing? I imagine it would, but what are your thoughts on just the arrangement of Congress right now?
Great question, Amy. That really plays in really well. And Ian said that we don't really know what's coming. And just to give a little bit of background to that, back in October, we didn't know what would happen in the presidential election. That would really impact tax policy, and we were watching that. And then after the election happened, and Congress was so narrowly split, and we still didn't know the outcome of Georgia, we were still waiting to see what sort of would be the makeup of Congress. And then now we're sitting with 50-50 split in the Senate, and that really does impact what legislation can come through. One of the main reasons for that is because the Senate needs a 60-vote majority to pass most legislation, and so since they're not going to get that with a 50-50 split, they have to go under different set of rules. Back in the 70s, the Senate set up what they called budget reconciliation rules that would allow them to pass a budget, which was important to do every year, on a slim majority, on just a majority vote instead of the usual 60-vote rule. And that has a couple of impacts. One, it limits what can be included. The budget reconciliation rules limit tax law changes that can pass with a simple majority. Limit law changes that can happen with a simple majority to things that impact the budget. And most tax items do, but not everything. And so we're going to be seeing a lot of picking at individual provisions and whether it can pass or not. Also, we have some Democrats who aren't on board with every change that's being proposed by Biden and most of the Democrats, or even some of the more liberal ones. And so they're going to need to court those votes, as well as try to get the Republicans to go along with some of their tax increase proposals. So I do see the slim majority really impacting timing, which is why I think next year rather than this, if at all.
Yeah, I think it's interesting in that, if memory serves me correctly, the TCJA, Trump's first tax bill went through under budget reconciliation. So it'd be interesting to see whether this is payback time. But Dave, to your point, yeah, I don't think the Democrats are completely aligned on all of these issues either. So, even with a simple majority, I don't think it's as easy as, rubber stamping that exercise. So, yeah, I'll be curious to see, like you said, is Elizabeth Warren gonna push through a wealth tax as opposed to some of these estate tax changes, and where they land on that. But yeah, I obviously something's going to go through as part of this process. I think typically, you're allowed 3 of these budget reconciliation bills, depending on the difference in the bills, but we've generally only seen 1 per year. So yeah, I guess it's we'll see what happens with this current act and kind of go from there. But yeah, that's going to be the curious thing, is seeing how the Democrats line up on some of these issues.
Yeah, there's a limit to how many they can do, and they have actually a little bit extra time this year because they never passed a budget last year, so they sort of had two at-bats. They're using up one right now with this additional rescue package, and they'll probably pick up the next one immediately after. And I just was reading that Senator McConnell was saying that they're probably going to try to do it budget reconciliation rules for the next one as well. And as an example of some of the things that might get picked at, we're waiting to hear if the wage limit increase will be allowed under budget reconciliation. That's an item that is it budget or not budget. The Senate parliamentarians get to decide that, and so we'll have to see what is allowed through.
Yeah, and I'm curious to see how how they sort of treat some of these expiring provisions. The SALT, the state and local tax cap of $10,000, the itemized deductions, the tax rates are supposed to sunset in 2025 and go back to the top rate of 39.6. How much of a priority are those sunsetting provisions going to be to change now versus getting other policy or tax policy changes through in their stead? So yeah, it's hopefully we get some idea about where this is headed over the next few weeks. I think, like you said previously, we're only 30 days into this presidency, so hopefully we get a little bit more of a flavor over the coming months. But yeah, it'll be interesting to see how it lines up.
Well, you mentioned payback. I think that'll play in, even though they're expiring. I think that the Democrats now having control of the White House and of Congress, slim as it is, I think they're going to try to push those Tax Cuts and Jobs Act changes right back to what they were before, because that's what they've been saying to do for a long time.
I'm glad you mentioned that, because I just had a question come in about that, specifically the $10,000 cap. I think that's something that's everybody's focused on. It was such a big change, and it limited and it increases people's tax on the state side. So I'm glad you mentioned that, because that question came in. Please ask more questions.
Yeah, and Amy, I mean, just on that point, I think that the idea is to take the cap away, but put the itemized deduction limitation back. So, depending on the gravity of the numbers, it may not be, a pure deduction. There may be a sort of limitation as you get above. Again, I think the limit that they're looking at is $400,000 of AGI. So yeah, they may get rid of the cap, but they may take some back with the itemized deduction limitation. So again, yeah, we'll just have to see.
And they may not change it back to what it was. It could be some conglomeration of something new and
right.
They're always surprising.
Yeah, that's an interesting one, Amy. That's one we've heard a lot about and has impacted a lot of people. To Ian's point, I do think that if they change anything, they're going to include both what's called the P's limitation, where you take a 3% of AGI haircut on all itemized limitations, as well as Biden has talked about putting a cap on total itemized deductions at, he's thrown out the number of 28% of your AGI, that you can never deduct more than that as itemized deductions at a certain income limit. I think that one's interesting because some of the changes we've seen with the CARES Act last year, with the pandemic, and even in the end of the year tax law changes, were increases to charitable limits up to even 100% of AGI. And I'm interested to see how that'll be impacted if they do implement sort of this 28% cap on all itemized deductions. On the 10,000, I'll give my opinion on that. I think that's an interesting one, because that limiting the state and local tax deduction to $10,000 impacted a lot of people, actually probably most filers, but it gave the most, it increased taxes the most probably for those that had the highest income, which is exactly who Biden's trying to target with any tax law changes. And so it's interesting to me that they've been trying to repeal that when that benefits the same people they want to penalize with a higher tax rate. So, and penalize is the wrong word. They want the ones that they want to have a tax rate increase on it. So that's just my thought, that I'm interested to see what plays out there, because they've been talking about repealing it, but I'm not really sure that they will.
Right. I'm very curious about the alternative minimum tax, because our tax law change was good, and last time around, last policy changes. But I'm curious to see if they're going to reinstitute that or change it or whatnot. I mean, alternative minimum tax is everyone's most disliked thing if they're captured in it. So what are your thoughts on AMT?
Yeah, I think philosophically, I get the AMT and I get why it was there. I think the issue we ended up with was that, none of the limits were increased over time. So you ended up with people who were clearly not trying to, increase their itemized deductions, dare I say, artificially to reduce their income. People who just were paying state income taxes in a high state income tax state were getting caught by the AMT, which I don't think is what it was designed for. So, I think there's room for it in the tax code, and I think it's on reflection a good idea, and it's a good anti-avoidance provision. I just think as long as the rates and the exemptions in place are, commensurate with where we are in 2021, that there's room for it there. And I think it's a tax rate and a tax policy that's designed to, capture the right people, dare I say, to Dave's point earlier about, Biden's approach being to obviously increase the taxes on the wealthy.
I'm going to actually disagree with you a little bit, Ian, on that. I'm not, this is my personal opinion, I am not a fan of the alternative minimum tax. I just think it adds too much complexity to the tax code where it's not needed. I think that if there are deductions that are too generous in Congress's eyes, they should just change the deductions or use some kind of phase out in income rather than creating a whole new regime for everybody that everybody has to calculate their tax twice. And the AMT is still in place, although it's largely gone away for most filers. I would say that incentive stock options are the biggest item I'm seeing that puts people in AMT in 2019 and 2020 and under current law, but it's still there and does impact people. And I would like it just to go away. I'll mention just in Biden's proposals for corporations, AMT did go away under the Tax Cuts and Jobs Act. But one of the items Biden has talked about is increasing the corporate rate back and also implementing what he calls a minimum book income tax, which is an interesting idea, but to me is just exactly the same. It's an alternative minimum tax, and I just wish that they would make it simple and change the tax law and not make a second set of rules that applies to everybody.
Well, and Dave, you bring up a good point, actually, because I know in one of the Biden proposals, there's talk of, sort of doing away with the deduction for like 401k and IRA contributions and just making them a flat rate, a refundable credit rate. So to your point about capping the itemized deductions at 28%, it feels like those kinds of things are, you're getting to the same odds that you would with an AMT, right? You're curtailing the ability to get higher rate deductions for some of these items. So yeah, I mean, it feels like you need to land on one side of the fence or the other on those. But yeah, it's a good point.
And just to add one thing to what you just said, I think the tax policy should be nimble enough to be able to change to circumstances. You brought up the 401k credit. I think that's an interesting idea and might target the right people. But I also think you need some consistency, and the tax law changes over the last 5 years and what's proposed makes it really hard to plan because they're always changing the rules. And so what you might set up in structure or plan to do for good tax planning is just made more difficult. Even retirement planning, which was made simpler under the Secure Act passed in 2019 with some bipartisan support. There's a lot of good changes made in simplification of retirements. And if they try to flip that up, it just makes things more complicated.
Yeah, and then, as a follow-on to that, do they have any obligation to give taxpayers any certainty? I mean, that's what we're all looking for, right? I mean, as advisors, we're all looking for some degree of certainty so we can plan ahead. When things keep changing every year or every change in administration, it makes that task that much more difficult.
Well, I have another question on, we've talked a little bit about federal and AMT and whatnot. Do you think we can expect any tax changes at the state level? Are you seeing any trends or specific states that may be ahead of the ball game on something like that?
Oh, Amy, that's an interesting question.
I'm going to share a screen here. I'm going to share a screen here too, just to give people an idea of what the tax rates are for the different states. I'll put it up for a little bit and I'll let you speak while I'm doing that.
Sure. Yeah, we've been talking at the federal level. State tax policy follows some of the same trends we've been talking about, but is interesting because there's so many different states. As you pull this up, Amy, you'll see there are some states that don't have an income tax, and so they're not impacted as much. Other states have been have had a constant income tax rate for a long time. Others seem to always be shifting, and we talked earlier about rates going up. Well, we're seeing that with some states, especially at the top marginal rate. California is already the highest in the nation, is talking about increasing their top marginal rate. Arizona last year passed an increase on their highest marginal rate for big earners. You can see the dark reds there. New Jersey, New York, Minnesota, Oregon have pretty high rates, and in almost all those cases have raised them recently. I think state tax policy is interesting. We won't talk about it much here, but there are a couple different things at play. People have a lot more mobility today than they used to, and the pandemic, working from home, only accelerated trends that were already in play about where people were moving to different parts of the country based on where they wanted to live, and not necessarily stuck in big cities like San Francisco, New York, Chicago, or DC, and have a little bit more flexibility. And it's even more so now. And I think state tax policy is going to have to adjust to figure out how to deal with that. The state legislatures don't have the benefit that federal government does of being able to print money or to have such a large budget deficit, either because of state law or just practical concerns about not having enough money to pay their bills. So we are seeing trends. I think upward state taxes is generally the trend, but also states are kind of incubators for trying different ideas, and we're seeing that every state has their own little thing that they're working on, trying to help people through the pandemic, or whether it's just trying to raise taxes to meet bills. Ian, you have any thoughts?
Yeah, I think the migrant piece is really interesting, Dave. As part of this fallout from this pandemic, people moving to different locales, or going home back to their original states and still working remotely for their employer in the big cities. How much of that is going to continue into 2022 and beyond, even when COVID, dare I say, goes away, and how will that impact the states where the employer is and how they tax these individuals, and the states where these individuals are resident and how they tax them? Because I can see there being a shift. The world is a smaller and smaller place, and each one of these events and each one of these new startups like Airbnb makes it smaller and smaller and makes people more mobile. Whereas it used to be fairly easy just to tax someone on the jurisdiction where they were working, and that was nearly always tied to where the employer was, that's sort of going away. It's certainly getting less. I don't know what the knee-jerk reaction is to that, but you're right. We're seeing states, aggressively increasing rates in a lot of cases, putting some of these stealth taxes in. I think California has that mental health tax over $1 million of income. And then, we're certainly seeing some sort of attack of non-residents, dare I say. There's a lot of withholding tax provisions coming in various states. You get non-resident individuals who are doing business in that state or are part of a partnership doing business in that state. So yeah, I think they're getting sort of more cute with their legislation. I think they're getting more aggressive in some of the things that they attack. And yeah, it's going to be an interesting year or two as we come out of this pandemic to see how they approach it.
And state legislatures don't have as much, they don't meet quite as often as Congress, so they don't have as many chances to change their law. Usually it's one session during the year, but we'll just have to stay tuned for each of those, what happens, and whether, as you said, rates going up, that might be pushing people out of the state. And so it's interesting. They are taxing non-residents. We're seeing that with these highest marginal rates, Arizona being an example of that, where I think they're trying to get the out-of-staters to pay the highest marginal rate on composite returns, for example. Ian, you have an international practice. Are you seeing any trends that are similar to what we're just talking about on the state level, at the international level, with mobility or with Biden proposed changes to international tax?
Yeah, I think it's been interesting. There's always sort of a push when we have a change in presidency for people to explore the expatriation option, because they think that there's going to be some fairly hefty tax changes coming in. The interesting sort of counterweight to that has been the pandemic. I've seen a lot of clients who want to explore this possibility of expatriating, leave the United States, either go and retire in another locale, or they can probably work in another locale just as easily. So they want to explore those types of. But the pandemic is it. There's a lot of clients thinking about retiring somewhere else. They want to be close to family just in case there's an issue and they can't get back. So in some cases it's really accelerated their want and their need to relocate either within the US or outside. In some cases it's put a hold on everything, and there doesn't seem to be a lot left in the middle of people who are doing this sort of short to medium term plan to retire or to relocate or what have you. So I don't know how that changes over time. I don't know if this is going to be a permanent mind shift, just because, as the pandemic made everybody think, look, something can happen tomorrow and who knows. And when the optimism comes back for some of those types of relocation options and retirement options, it's difficult to tell. But certainly right now, yeah, it's been a catalyst to push people either to do nothing or to accelerate their plans.
Thank you. Well, I think you both touched on it a bit already, or alluded to it, but how has the coronavirus pandemic impacted tax planning for you and your clients with all of the changes? How specifically has the pandemic impacted this?
Good question. I would think that the pandemic itself, it's mostly been there have been the softer things, as Ian mentioned, of clients thinking about family and thinking about what do we enjoy and what do we like to do. That seems to be a theme for everybody. It has given us a chance to sort of step back and say, yeah, taxes, I get it, but also what's more important is how is everybody doing, and are people well and healthy? Are we taking care of each other? And I'd like to see that. The policy implementation of, say, the CARES Act last year, and even the legislation that they're talking about now, has a huge impact on planning, and it's frankly been hard. There's just been a lot of changes that make things more difficult. They very quickly rolled back we had huge changes to the NOL rules, that's the net operating loss carryback rules that the Tax Cuts and Jobs Act changed, and then very quickly in the CARES Act, they rolled those back and made it easier to carry back losses and claim refunds. And just planning overall has, I think, been difficult just because of the consistency. It's hard to know what is changing. People have been asking, well, do I accelerate income? Do I recognize income now, or do I do it next year? Is it 2020? Do I do it in 2021? Do I do it in 2022? What about my charitable giving? If they keep changing the law, how do I structure my charitable giving the right way? Or when do I pay my state taxes? Do I pay it in 2020 so I can get the deduction if they retroactively change? That was a question I got back at the end of the year and from a lot of clients. It's just really hard to plan when there's not consistency. So we're really trying to stay up with what's happening and adjust our planning to those different scenarios. But until a law is passed, it's really hard to plan for that.
Yeah, I think it was, the pandemic and the election was kind of a double-edged sword for that, Dave, right? Again, we're back to this lack of certainty. Those two wild cards, it just made it impossible to sort of guess even beyond sort of the end of 2020 what was going to happen. So those are really difficult questions to answer for us. And again, hopefully we get a little bit more certainty here going forward. But yeah, the pandemic seemed to, like I said before, sort of push people to either end of the spectrum, depending on where they were in life and with family and things like that. And yeah, it's a challenge. There's no question.
I do have a question that came in, a very specific question. What is the worst of the Biden proposals that are unlikely to pass? A negative there. Well, I guess first we talk about the worst ones, I guess.
Depends how you define worst, I guess.
Exactly. They're all, yeah.
Yeah, that's hard to say. I'll mention, we've talked about a lot of the proposals. I'll give some just my guesses on what I think will happen. I think that the taxation of long-term capital gains has been something that's been talked about for a long time, and the trend, I think, in policymakers has been towards no, we're not doing that, towards actually that sounds like a good idea. That's been what I've heard, especially from the Democrats and the more progressive Democrats. And so I think the likelihood of that coming to pass is high. I don't know timing. We guessed 2022 earlier. It could be later than that. And they've said the cutoff might be $1 million of income. That might be the cutoff where you get ordinary treatment. I don't know the form, but I think that's likely. I think there's also likelihood that some of the rollbacks of changes will happen, whether it's getting rid of the qualified business income deduction, that's the 20% deduction, at least for those making over 400,000. I think that's likely. I think a change to itemized deductions and maybe a cap is likely. I think that to answer the question specifically, I think that the instituting Social Security taxes on those making more than 400,000, creating what they call a donut hole, where you reach the cap and you don't have to pay Social Security taxes until you hit the 400,000, and then being subject after that. I think that's unlikely to happen. The reason I would guess that is just that I think that Social Security is one of the things that you can't touch in the budget reconciliation rules. And so I think it would be hard for them to make that change under budget reconciliation. So under the current makeup of Congress, I don't think that one would happen. Just a guess.
Yeah, Dave, I agree. I don't think that one's going to happen as presented. You know, it wouldn't surprise me to see some sort of change to the ceiling or something, but even that hole in the middle seems disingenuous. I think if I had to pick another one, I think this sort of trinity that they've offered on the estate tax of reducing the exemption, taking away the step up in basis, and increasing the rate, I'd be surprised if all three parts of that went through. There's going to be a change to estate tax or a wealth tax. There's no question. But whether all three of those go through as presented, I would be surprised.
And we are seeing a big change right now in the lower end, where they're increasing the earned income credit, they're increasing child tax credits, and even talking about making that something that comes out as a check every month, kind of an advance credit to families. I think that's highly likely, and I think that changes the whole landscape of, personal opinion, I'm not really sure why the IRS, this part of the government, is the one that we're putting in charge of putting money in the hands of people. But that's the form it's taken in, and I expect that trend to continue. And we're not talking much about any kind of estate tax, wealth tax much, but there are some changes, I think, coming there. As Ian said, I just don't think that'll be very soon.
Our next section is on that, so that should be really interesting. Okay, so you both talked about the uncertainty. We all know, this is a crystal ball time, but we're getting a lot of questions from our clients. What can I do now? What can I do now if this happens, and you talked about the difficulty in planning. I just thought maybe you could say again, what are you telling your clients when they say to you, what can I do now if any of these things are going to happen next year or whatnot? Are we still waiting, or what are you telling your clients?
I think from my perspective, Amy, it's one of those, there's going to be changes. There's no question about that. Something is going to happen here with that capital gains rate and qualified dividend rate. Something is going to happen at some point with the estate tax. So I think it's a case of, talking to clients about being current, talking to clients about current balance sheet, talking to clients about future plans, and quite honestly, just sort of, pro-forming scenarios to figure out, what if this happens, what if that happens, so that when we do know what the changes are going to be, we can be nimble in terms of pivoting and advising and tax planning. But it's difficult to say with any certainty to do X or Y today. But I think we can certainly get our sort of ducks in a row to be ready to move once we do have an idea about what's going to be enacted and more importantly, what's going to be enacted soon.
Right.
Yeah, I would agree that flexibility is really important. We talked about the government being nimble to change tax laws. I also think that we should, in our financial planning and our tax planning, should try to be nimble as well. I don't think we should try to guess what's going to happen and base our behavior on that. I think we have to go with what we have. I'll also mention that we have talked about the immediate tax law changes. I think if we look 3, 4, 5 years down the road, there could be changes and swings the other direction. We're talking about increases, and I think tax rate increases are probably a long-term trend that's here to stay, but there could be different changes that pop up, and so just preparing for the worst isn't always necessary. The Tax Cuts and Jobs Act that happened in 2017 brought about the 20% qualified business income deduction, something that hadn't really even been talked about or floated or anticipated. And so there can be swings both directions. One area I'll mention that I think is important to have some flexibility in, well, two I'll mention. The first one, in capital gains, it's hard to say, well, we think rates are going to go up, so we think you should recognize income. You know, that's not what we do as financial planners or tax planners. Often we're not usually accelerating income, and I don't know that that's usually going to be the most advisable thing, that you should recognize capital gains now so that you don't have the higher tax rate in the future. I think we just have to manage it as it comes, and I don't think accelerating is always going to be the option there, but it's something to think about. Again, not necessarily something I'd always recommend. The other item is maybe on retirement planning, on flexibility. I like the idea of having a diversification even among retirement accounts. You know, we have Roth options, we've got traditional 401k, IRA deductions, we've got after-tax contributions. We have some flexibility when to take distributions from retirement accounts, whether that's early in retirement and managing your taxable income, or whether that's waiting till required minimum distributions kick in, whether you use qualified charitable distributions from your retirement account to fund your charitable goals. That all those things help you manage your taxable income every year, and I think that we should plan for flexibility. There's a lot of options out there in something like retirement accounts, and that would be an area where I advise planning ahead and trying to use your own flexibility to drive your own tax answer.
And Dave, I just want to touch on something you said there. That qualified business income deduction was a surprise. And it's entirely possible that all these things that have been mooted around to this point, we get something, completely different, something completely out of left field. So yeah, because of that, the flexibility is massively important.
Yeah, opportunity zones are another example of something that just a brand new change, a brand new, not something that works for everybody, but there are opportunities that will come up for tax planning in the future that we're not aware about yet.
Right.
Thank you. I have had a couple of questions come in. They're specific to the estate tax, which that's awesome because our next session is all about that. But I know that they're going to be using their crystal ball as well. So let me read you these two. The more opinions, we all have them, right? So the first question is, what about estate tax exemptions? Do you think the current exemption will be lowered?
Broadly, yes, I do. The estate tax exemption seems to be the political football of all political footballs. It seems to bounce around depending on the change in administration. Again, there's been a huge push to, or at least there's been a lot of rhetoric from the Democratic Party around, having a wealth tax, having an estate tax reduction. My guess is, the exemption comes down. Whether it comes back down to the sort of 5.5 million range or the 3.5 that Biden has mooted, I don't know. Whether they make a separate push now for a wealth tax, I don't know. And what will that do to the estate tax? But yeah, I think based on history and based on, the level of discussion around this on the campaign trail, yes, it's going to change. And I think it's only going to change in terms of rates going up overall rather than rates coming down.
Right.
Yeah, two thoughts I'd share. One that is that if you look back the last 10 years, we've had so much change in this area. And I think looking forward, we're going to have change again. So again, flexibility is important as you think about planning. I think that the exemption will go down. My personal guess is that it won't get touched by legislation, but that the sunset will occur in a couple of years and that it'll just go down as a function of the current law. We already know it's going down. And I think that Ian touched on the political football. I think that they just leave it alone and it goes there. I'll give my thought that I think the exemption being at a certain height is very administratively practical. The estate tax is extremely difficult to administer, and frankly for taxpayers as well, it's just a burden. And if we can set some limit, whether it's $1 million or whether it's $11 million or 25, whatever the number is, there should be some limit where we just don't worry about it. And I think that was one of the reasons for the increase. And personally, I think that the increase is, even though it'll come back down to what it was before with the sunset, my guess, I think that it'll stay at that level only because administratively that's so much easier. I hate to pick on the IRS, but it just saves them a lot of a burden. I think you mentioned, Amy, a question about retroactivity. I think that we've got some good precedent from the Treasury where they've already told us that when the exemption goes back down, there will not be a clawback on the gifts that were already made under the higher exemption. And I think that sets some good precedent, at least from a planning perspective, that we see that the Treasury is not trying to push these bounds on this, and that they're recognizing that people are taking action based on current law and that they should respect that.
Excellent.
Yeah, just, I mean, for whatever it's worth, Amy, just one final point on that. If you look at other industrialized nations, they've either got a wealth tax or an inheritance or estate tax with a much lower threshold. The US is kind of alone in terms of how, dare I say, generous they are towards that approach. So, you know, take that for whatever you will, but yeah, it'll be interesting to see where this heads.
It's true. I mean, the US isn't the highest tax country either. A lot of people think, oh, we pay so much. There's a lot of countries that have such a higher tax rate, or maybe a flat higher tax rate. So our taxes are very complicated. Other countries don't tend to have as complicated sometimes. Let's see. We don't have any more questions you addressed retroactively. Do you have any other thoughts you'd like to add? We are out of questions specifically. Any
I mean, it's final thoughts there. It's interesting times. It's, you know, it's kind of it's a lot of work just keeping up with all the discussions. You know, we had a week ago, the House Ways and Means Committee wanted to extend the tax deadline this year. Yesterday, the Commissioner of the IRS said he didn't think that was a good idea. You know, every day it's something else. And I get it. It's some of that's the pandemic, some of that's how resource stretched everybody is, some of that's how much backlog there is from last year.
Politics too.
Yeah, it's you know, it's going to be an interesting 12 months. It's going to be a 12 months sort of akin to the last 12 months we've had, just in terms of, you know, every day it's something else. And yeah, you know, I can't stress this enough. The flexibility, the ability to be nimble when some of these changes come down is going to be critical for tax planning and financial planning in general, I suspect.
Yeah, I would share, Amy, we've talked about a lot of topics, some real specific, some just sort of general. When we approach tax planning, we try not to focus in on the details of proposals from the campaign trail, or even what senators or congressmen, women might be saying in their committees, sort of what they think and what they want to have happen. We try to tend to focus on what the law currently is, and when tax law changes are passed, what's in it, because there can just be so much change. It's hard to nail in on the nitty gritty. But we do see trends. We do see things that Biden has said over and over again. Here's where I want to push things. And we are also seeing trends in where the budget deficits do seem to be increasing, and there's talking about ways for paying for that. And so I think watching the trends is important, and being aware of what gets repeated over and over again, but not getting narrowed down in the details. Timing, I think, is a huge question on everybody's mind, and unfortunately we just don't know, and Congress can probably do whatever they'd like. I would think that based on the slim majority in Congress, what we're seeing right now in the pandemic, and sort of the tone that we want to get through this first, is indicating to me that we won't see the tax rate increases in 2021, but I think it's highly likely that 2022 would be where we see some of these big changes. And I think that the tax bill that implements that will be started and be talked about quite a bit in the summertime. So that's when I would be looking to see if there isn't much talk of a bill actually happening in the summer. I think that could get pushed out a year.
Great. We do have 10 minutes left. We still have time for questions. I had some interest in the state tax rate slide, so I'm going to put it back up for just a little bit, and we can wait for some more questions and talk about anything else you'd like to speak on.
Yeah, Ian mentioned the tax deadline, and we talked earlier about states. I'll just mention from my practice that having the extra time last year did make things easier as we all went into hunker down mode and so many things changed, but the state piece of that was the most difficult to try to keep up with and figure out what's the right, when do we have to file and by when. I can't say what's going to happen this year. Ian already told us what the commissioner said. We've already heard what the Congress wants, but we do know that in Texas, for example, the IRS has already extended the deadline till June 15th for all tax filings and payments because of the winter storms that have happened recently. I think there are some outliers to continue, but I would expect that we stick with our April 15th deadline would be my guess on deadlines. And of course, if you have any questions about any of these topics we've covered, we're happy to have a further conversation. Tax is interesting because it's so personalized. Your tax return it can be very, very different than the next person's, and so having an individual conversation about it can be really important. I'll also mention that in the press and in Congress, we're hearing lots of terms and lots of they like to categorize. We've got the 1%, or they'll talk about the wealthy or the rich, or just different categories of people. And in my experience, it's really hard to categorize people into tax buckets. Everybody has their own unique situation that could vary wildly from year to year. And so having an individual conversation about to answer your questions, I think is important to.
Yeah, Dave, it's funny when they put together like these tax proposals and they always say like, this is going to raise X number of dollars and here's the demographics it's going to come from. You can look in that and say, yeah, I've got clients in that line there, and some are going to be really affected by this tax change and some are not going to see a change at all. So it is, it is interesting to see how they break all that down.
This is the time when we are closely like meteorologists. If we ever aspired to be meteorologists, this is our chance to kind of, give our thoughts, our 2 cents.
Yeah, thanks, Amy, for giving us a chance to talk about some of these things.
Great. Well, thank you, everyone. Thank you, Dave. Thank you, Ian. Thank you so much for your interest and taking the time to join us today. Hope you found it helpful. And if you have any further questions for us, please contact us. You have our contact information, or feel free to reach out to anyone on your SBSB team. As I mentioned a little earlier, we have one more session on the main stage, and we're going to be discussing how the Biden administration may have implications on your estate planning. So if I know a few of you are definitely interested in that, so I hope you'll continue to join us. Again, thank you so much.
Thanks a lot.
Thanks, Ian. Thanks, Amy. Thanks, everyone.